Did you know that about 80% of individual investors fail to outperform the market?
That's right!
According to a study by Dalbar, most people who invest in stocks often end up with lower returns than the S&P 500. Shocking, isn't it? Many think they can beat the market with their picks, but the truth is that investing in stocks comes with risks that most don't fully understand. In this video, we're diving deep into the world of stock investing to uncover why it might be riskier than you think. We'll explore the illusion of control that many investors have, the hidden fees that can drain your profits, and the dangers of following the crowd. You'll learn how to protect your hard-earned money and make smarter investment choices. So, if you're ready to challenge what you thought you knew about investing and gain insights that could change your financial future, stick around. We're about to uncover some surprising facts and share powerful strategies to help you navigate the tricky waters of the stock market. Let's get started. Chapter 1. The illusion of control. What the charts don't show when it comes to investing in stocks, many people think they're in control. They study charts, analyze trends, and make decisions based on what they see. But here's the truth. Much of the market is unpredictable. According to a study by the American Economic Association, about 70% of price movements in stocks can be attributed to factors that have nothing to do with the company itself. This means even the best analysis can't guarantee results. It's easy to fall into the trap of overconfidence. A quote from psychologist Daniel Kahneman in his book Thinking Fast and Slow highlights this. We are blind to our blindness. Investors often ignore risks because they think they have a solid grasp of their investments. To combat this, always ask yourself, what could go wrong, before making a decision. One effective strategy is to diversify your investments. Instead of putting all your money in one stock, spread it across different industries and sectors. This way, if one stock falls, others may rise, balancing your overall risk. Remember, the goal isn't just to chase returns, but to protect your capital. Also, stay updated on market news. Understanding economic indicators like interest rates and employment numbers can give you insights into market movements. The stock market can react wildly to news that seems unrelated. For instance, a natural disaster can lead to unexpected stock fluctuations, regardless of a company's performance. Finally, develop a strong risk management plan. Set stop-loss orders to protect against sudden drops in stock prices. This strategy automatically sells a stock if it falls below a certain price, helping you minimize losses. As the saying goes, it's better to be safe than sorry. Chapter 2. Beyond the Basics. Hidden Fees and Costs. Many investors focus on the stock price, but hidden fees can be a silent killer of profits. According to the Investment Company Institute, the average mutual fund fee is about 1.5%. While this may seem small, over time, it can eat away at your returns. Imagine investing $10,000 with a 7% annual return. After 20 years, those fees could cost you nearly $25,000 in lost gains. One effective strategy is to choose low-cost index funds. These funds typically have lower fees compared to actively managed funds. According to research from Morningstar, $1 invested in a low-cost index fund can outperform one invested in a high-cost fund by over 2% per year. That adds up over time. Always read the fine print before investing. Many platforms hide fees in complicated terms and conditions. A recent survey by FINRA found that 50% of investors didn't realize they were paying trading fees. Knowledge is power. Knowing the costs associated with your investments can help you make better choices. Another useful strategy is to invest in commission-free trading apps. Many of these platforms have emerged, allowing investors to buy and sell without paying hefty commissions. This can save you a significant amount over time. Just be cautious and research the platform's features to ensure it meets your investment needs. Remember to factor in taxes as well. Long-term capital gains are taxed at a lower rate than short-term gains. Holding on to an investment for over a year can lead to significant savings. Understanding your tax implications can be just as crucial as picking the right stock. Finally, regularly review your investment portfolio. Evaluate the performance and associated costs of your investments at least once a year. This practice can help you spot high-fee investments that are underperforming, allowing you to make timely adjustments. Chapter 3. The Herd Mentality. When everyone's wrong. Have you ever noticed how people tend to jump on the latest stock trend? This is known as the herd mentality, and it can lead to disastrous outcomes. Research by Nobel laureate Robert Shiller shows that bubbles like the dot-com bubble are often fueled by this very behavior. When everyone is buying, it's easy to think you should too, but this can lead to significant losses. One strategy to combat the herd mentality is to develop your own investment thesis. Create a personal checklist of factors to consider before making an investment. Ask questions like, what are the company's fundamentals? Or, how does this fit into my overall strategy? This will help you think critically rather than following the crowd. Another important approach is to stay informed about market trends and economic indicators. Follow reliable news sources and financial publications. This knowledge can give you an edge over investors who simply follow trends without understanding the underlying factors. Remember, informed decisions often lead to better outcome. It's also beneficial to consider contrarian investing. This strategy involves going against popular opinion. When the market is overly optimistic, look for opportunities to sell. When fear grips the market, consider it a buying opportunity. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. Additionally, use a limit order instead of a market order when buying stocks. A limit order lets you specify the price you're willing to pay, which can help prevent impulsive decisions based on market fluctuations. This strategy encourages patience and discipline in your investment approach. Finally, maintain a long-term perspective. Remember that investing isn't about quick wins, it's about building wealth over time. Focus on your investment goals rather than daily market movements. As the old saying goes, it's a marathon, not a sprint. Embrace the journey, and you'll find greater success in your investing endeavors. If you're finding this information helpful, make sure to subscribe to our channel for more insights on investing and personal finance. Chapter 4: Risky Business: Understanding Correlation and Diversification. When it comes to investing, many believe that spreading their money around reduces risk. But there's more to diversification than just buying different stocks. It's crucial to understand correlation, the degree to which two investments move together. For instance, during a market downturn, many stocks might fall in tandem, which could lead to significant losses. Research from Harvard Business Review shows that truly diversifying your portfolio can reduce risk significantly. A mix of assets like stocks, bonds, and real estate can provide a buffer against market volatility. In fact, studies show that a diversified portfolio can lower risk by up to 30%. One effective strategy is to consider investing in assets that are not correlated. For example, real estate often behaves differently than stocks. While stocks may tumble during a recession, real estate values might hold steady or even increase. By mixing these asset types, you create a safety net for your investments. Another smart move is to invest in international markets. While U.S. stocks may be facing a downturn, stocks in other countries might thrive. According to MSCI, global diversification can enhance returns while lowering overall risk. Look into funds that focus on emerging markets for potential growth opportunities. Moreover, consider using exchange-traded funds, ETFs, that provide built-in diversification. ETFs can hold a basket of stocks, giving you exposure to various sectors without needing to buy individual stocks. This approach can simplify your investing process and reduce risk. Regularly review your portfolio to ensure that your investments still align with your risk tolerance. Economic conditions change, and your investment strategy should adapt accordingly. If your portfolio becomes too heavily weighted in one area, it might be time to rebalance. And don't forget to include alternative investments, like commodities or precious metals, in your strategy. These can provide a hedge against inflation and market downturns. For instance, gold has historically retained its value during economic crises, making it a popular choice for diversification. Chapter 5: The Long Game: Patience or Peril. Many investors believe that holding stocks for the long term is a safe bet. However, this mindset can be risky if not approached wisely. A study from Dalbar shows that investors often earn lower returns than the market due to emotional decision-making. In fact, the average investor's return lags behind the S&P 500 by nearly 5% annually. To truly benefit from a long-term strategy, it's essential to stay informed. Market conditions can shift quickly, and what was a sound investment a year ago may no longer be wise. Keeping up with economic trends and company news can help you make informed decisions. One strategy to enhance your long-term success is dollar cost averaging. This approach involves regularly investing a fixed amount, regardless of market conditions. By buying more shares when prices are low and fewer when prices are high, you can average out your costs over time. Research indicates that this method can lead to better investment outcomes, especially in volatile markets. Another key to long-term investing is setting clear goals. Ask yourself what you want to achieve. retirement, buying a home, or funding education. Having specific goals can help guide your investment decisions and keep you focused on the big picture, even when the market gets bumpy. Be wary of market timing. Many investors try to predict market movements, but studies show that timing the market is nearly impossible. According to JP Morgan, missing just a few of the best trading days can drastically reduce your returns. Instead, focus on your long-term plan and avoid getting caught up in daily fluctuations. Lastly, establish a strong emotional foundation. Fear and greed can drive irrational decisions. As Benjamin Graham, the father of value investing, said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." Keep your focus on the underlying value of your investments, rather than the noise of the market. If you found this information valuable, don't forget to subscribe to our channel for more insights on investing and personal finance.